Hey, it's Joshua here with another edition of Mortgage Clarity. And in this episode, we're going to talk about the difference between a non-QM and a QM loan. Is one better than the other? So let's start. Probably the best place is, what does QM even mean? Well, QM stands for qualified mortgage. Okay, great. So what's that? Well, after 2007, 2008, a lot of federal regulation came out because of the financial crash brought on by really crazy lending practices. All kinds of loan programs that were kind of the most aggressive, you might call the liar loans, where a borrower, simply because of the strength of their credit score, could state on their application what their income was, regardless if it made sense, or even no income at all. They call these ninja loans. No income, no job, no assets, nothing goes on the application, just a credit score. And if you met that credit score requirement and the down payment requirement, you got a loan. Okay, so because of that practice, we ended up with a crazy market that collapsed upon itself. So out of that came a bunch of regulations and what's called a qualified mortgage. Now, this is going to be what your conventional Fannie Mae and Freddie Mac loans are like. FHA and VA and USDA have their own programs as well that fall into how they go about this. The key thing here is, on a qualified mortgage, is the requirements of how a lender goes about showing the borrower's ability to repay, or ATR. Now, both QM and non-QM have this requirement now. A lender must show ability to repay, so no more ninja loans, no more liar loans. But the big difference is, how do they go about doing this? So on a qualified mortgage, a borrower is going to have to prove their income with pay stubs, bank statements, and tax returns. Traditional, very easy to document type income. And that's what the lender has to use. Additionally, a qualified mortgage has tighter debt to income ratio requirements. It doesn't allow a lender to offer terms that exceed a 30-year fixed rate mortgage. And it cannot offer what's considered risky features to it. So no interest only payments, no negative amortization payments, no balloon payments. So negative amortization is one of those programs to where you actually pay each month less than the interest incurred on the debt, which means your balance on your loan, instead of staying flat or going down, it's actually growing over time. Can't do that with a QM. Also, a QM loan or qualified mortgage has specific debt to income ratio requirements that you must be at or below. So these are just some of the key points of what that really is. Now, what a QM loan does for the lender, a couple things. One, vast majority of loans are done to conventional underwriting, a Fannie Mae or Freddie Mac. And this is important for a lender because it allows them to lend a lot of money, of their money. After they lend the money, securitize it and sell it into the market. And because at any point that loan could be purchased by Fannie Mae or Freddie Mac, it creates liquidity in the market and a place for a lender to be able to sell, get that money back, and lend again. If it's a non-QM loan, you're not going to be able to sell this to Fannie Mae and Freddie Mac. So that's one thing. The other thing is, for the lender, a qualified mortgage gives them certain safeguards against a consumer coming back and be able to try to sue them for maybe saying that you gave me a loan I couldn't afford, and because you did that, I lost my home, that's your fault. And so they want to sue the lender for that. If it's met the QM standards, there's really not much a borrower can be able to do to come back, as long as the lender didn't falsify anything, in which case that's always going to be a foul. So is a non-QM loan, because it doesn't meet these standards, does that make it a bad loan or a risky loan? It does not. What the non-QM loan does is it opens up a field for borrowers who might not otherwise be able to qualify through the stricter standards of a qualified mortgage, but they're still good borrowers. The lender still has to show the ability to repay, but now they can be maybe a little bit more creative to take into account those things that a QM just doesn't, because it's black and white. So again, one example might be, on a QM loan, you're prevented from paying more than 3% in points and fees. So that doesn't mean that the lender can't charge you 3% in fees. I mean, well, it does, but I'm just saying that 3% points and fees doesn't mean the lenders are charging you 3%. That's a lot to charge. But people like to pay points to buy down their interest rate. Well, you might want to pay more points to buy your rate down lower than what a QM would allow, but because you're capped at that 3%, that's not an option. Also, for certain borrowers, their income just can't really be documented very well traditionally. So an example where a non-QM loan can step in is with self-employed borrowers that maybe just the way they do their taxes and they write things off, it really restricts what they could afford on a QM loan. But a non-QM product might allow like a bank statement program where you're documenting your income, but instead of doing it through taxes, you're doing it through deposits through that system. So just, again, that's just one example. The other example might be things like, interest-only loans, which might be advantageous for a certain borrower, particularly if it's like an investment property, or if it's maybe 40-year terms. Even on these things like interest-only loans or adjustable rate mortgages, it's important to realize on a non-QM loan, they're still required to show the borrower's ability to repay. They're just different on how they do that. So there you go. That's a kind of a brief overview. Again, this video is not to go in about all the different types of non-QM loans. There's a lot of different things there: debt service ratio loans, bank statement loans. But again, this is the difference between the two. Neither one is necessarily a bad loan. Usually the problem is not a bad loan; it's a bad mix-up between the borrower and the loan they got. But that's a non-QM, just simply a loan program that's going to use a different type or a different way of showing the ability to repay compared to a qualified mortgage, and offer different loan terms that might otherwise not be allowed in a fully qualified mortgage. So I hope you found that helpful. Again, if you like this video, just please hit the like button. It helps bring this attention to other people out there in the internet world. Subscribe to the page if you want more content. Please leave comments. I'd be happy to respond to those, and have a fantastic day.